video for our November. I am Scott Tomlinson, and with me on the call today is Paul Tepsich, the founder of High Rock and our portfolio manager. And today we are going to talk very quickly about what happened in October. We're a little behind schedule for getting this out, but we've been rather busy, and we'll get to that in a second, putting together a preferred share mandate over the last few weeks. So that's taken up a lot of our time, but we still have time to talk a little bit about what's been going on. October was volatile. September was volatile. October continued to be volatile. Those are actually October prices, not September prices. But you can see that stock markets continued to be weak. Bond markets actually were fairly neutral, which did help balance portfolios to a degree. Gold was the best performer on the month, and interestingly enough, real estate investment trusts in Canada were weak performers, and certainly that has a lot to do with what's going on as far as the rental or leasing of space. And I would say downtown Toronto is still pretty much a ghost town, right, Paul?
Well, that is true. Certainly, Mondays and Fridays. But I would also add that, as you can see there, the worst hit were what we would call like higher yield plays, being the REITs. They pay out a big portion of their free cash flow in by way of distributions. Preferred shares pay out a dividend. Common equity pays out a dividend, etc. So it's a competition for yield as well. That's part of the reason why those are down specifically. Any dividend paying stock, has been hit pretty hard the past 2 months. The likes of the utilities, pipelines, the telcos, the banks, because there's competition for yield. Now you can go buy a GIC for a similar yield. So now recently, over the past week, we're recording this November 8th, but the past week and a half or so, we've seen government bond yields drop rather dramatically. So some of these that we're looking at now have improved as well. So as rates go down, those high dividend yields at 7% become more valuable. That's the other part of the reason.
Yeah, sure. But back to the REITs, occupancy certainly is a key, and having lower occupancy levels would not allow some of the REITs to compete with better distributions and as a result a higher yield, right?
Absolutely. And for the record, we have in the past, maybe 7 years ago or so, but we haven't owned any REITs, and we'll continue to not own REITs at this stage. If we ever did, it would be for a trade, not a core investment.
Exactly. Okay, good. And just to talk a little bit about more about balanced portfolios, we tend to follow the iShares Core Balanced ETF as a bit of a benchmark, and one of the most important aspects of the balance is what level of risk are we comparing our portfolios to? What level of risk do our portfolios or our client portfolios have relative to the benchmark? And again, this is another conversation that we want to have with clients when they want to understand fully what kind of risk they're looking at, because we can show them individually, because all portfolios are tailored to very specifically specifically look after client needs. So, but these are conversations that we would love to have, and we stand by and are always happy to have those conversations.
And Scott, if I could just add on that slide, you can produce for a specific client a lot of the metrics that we're looking at in the middle, specifically risk and volatility measures, so they can compare how their portfolio is done against, say, this portfolio, if they so ask.
Absolutely. And of course, you'll notice that not only is in this Morningstar is comparing the XBAL, which is actually in its sort of higher quartile uh, as a balanced portfolio relative to the what they would consider the index or the a comparable balanced index, and even the balanced ETF here that we're looking at is outperforming that index. So, yeah, we're happy to have all these conversations and talk about exactly what your portfolio is doing. And it's really important too to understand the balance and how the balance works and what is going on in the bond part of the portfolio, because a lot of people see the mark to market on a daily or monthly basis, and that mark to market is as if you sold your portfolio on that very day, and that's what you see when the total value of your portfolio is presented to you. But our plans for the future are not to sell on any given day, especially with bonds. Our intention is to mature those bonds, and right now there's a significant discount between current prices, which would be shown on a mark to market, and maturing values, which aren't shown. So that's another part of the conversation, and I've had a number of them with our clients, and anybody who wants to have that conversation with me should make a point of reaching out. Anything you need to talk about special mandates? Let's talk just, Paul, really, I mean, about our preferred share mandate a little bit. As I mentioned, we've had a fair bit of interest. It's something that we're happy to have a conversation with anybody who would like to know more about it. It is trying to take advantage of what we see, or what Paul's model shows us has created some significant value that takes a little bit of the risk out of owning preferred shares going forward, and being able to capture some very tax efficient dividend income. Paul, you can talk a little bit more if you wish.
Yeah, sure. Thanks, Scott. The last time this occurred, the pref market was this dislocated. It was back in 2016, that summer, and we actually did a special mandate for just one investor that lasted about 2 years, and it worked out quite well. And we noticed back in August and certainly through September how dislocated the market had become. So we started talking to a few individuals, and we've had decent take up. Now, I just want to say this to all of our clients who are in the balance mandate, as Scott, you and I both are. We already do own some preferred shares and have exposure to this market through our fixed income model. And we're actually looking at adding a little bit. So this is not for everybody, for sure. There are some people in our high yield mandates that are using it as a bit of a hedge, and there are others who are using it as a one-off opportunity. But we all, in our balance mandates, have exposure to this. But having said that, if anybody wants to learn more, we did have a call a few weeks ago, I believe. We did not record it, but if anyone is interested or they want to see if it's suitable, it has to be suitable. If they want to know more, please contact Scott or I, and we're happy to have a one-on-one call with you, and I can go through it in more detail. And they are very, very complex.
Excellent. Okay, thanks, Paul. And of course, everybody knows that we're tailoring everybody's portfolios very specifically to their goals and their needs. The preferred shares do tend to be better for clients who eventually need cash flow, because it is tax efficient and it does provide cash flow. So if you're drawing from your portfolio, preferred shares are not a bad vehicle to own. And as Paul said, in the balanced mandates, we do own some preferred shares. The question is it something that you might look at owning more preferred shares down the road, because that would suit your portfolio? So that's what we want to have conversations about. Everything is about what your specific goals are, and of course they're tailored very specifically to your portfolio strategy. Anything to talk about in the global equity strategy? Not really. Equity markets have bounced from their October lows in the last week. From my perspective, it is just another opportunity to rebalance portfolios and take sales and lock in some longer term profits. My view going forward is that there's a lot of, like the preferred shares, higher bond yields, even GICs, could likely outperform equities over a short period of time, with higher interest rates slowing economic growth. And that we see is certainly going to be a problem in Canada. Paul, I saw an article last week that said there is 900 billion in mortgages coming up for renewal over the next few years. That's pretty significant.
It's huge, and I'd be shocked if interest rates aren't lower by then. That's for sure. I think the Bank of Canada could very easily start cutting rates over the next 6 months. I think the consumer is completely tapped out in Canada. The US is an entirely different situation, but Canada is in a lot more difficult shape than the US. We shall see. Tactical model. The only thing to add, no trades. Our core energy holding in Baytech stock, they just reported Friday, I think Thursday night, call Friday, and they instituted a new dividend, which was not largely unexpected. It's very small to begin with, but they are allocating 50% of their free cash flow to debt repayment and 50% to shareholders by way of continued NCIB or normal course issuer bid, i.e. buying back stock in the open market, and now paying a dividend for the first time in a very long time. So that's good news, although oil has been getting absolutely hammered the last few days, but we still are quite bullish on energy and willing to wait with this position. And that's it for tactical. Fixed income is the only thing to add in there, besides, I could say, as I did before, the past week and a half or so. Now we're into November 8th today, but interest rates have dropped dramatically. Just to give an example, US 10-year treasuries topped out at 5.02%. Today they're at 4.51. So they've rallied over 50 basis points in the last week and a half. They are extremely volatile. So that move lower in interest rates means bond prices go up. That has helped on a mark-to-market or unrealized basis over the last week or so. The other thing to add in our investment grade portfolio, or investment grade portion in orange, we own Ford Motor Company, Ford Motor Credit Canada, in fact, which we quite like because it has a double guarantee, both from Ford Motor Credit in the US and from Ford Motor Credit Canada. But they got upgraded, so that was quite helpful. And the bonds moved up from sort of par, being 100 to 102 area. So that was good. Brought in a whole new class of buyers, so that was helpful. And that's it for fixed income too.
Just that they got upgraded from what to what, Paul?
It was just one of the agencies that moved them up to investment grade BBB, I believe.
From a double B.
Yeah.
Excellent. Okay, well, that's good news for all our clients, because they all have some ownership of that particular bond. That's it. As always, we want to thank you for taking the time out of your busy schedules to tune in. We'll be back with our next update at the beginning of December. So until then, this is Scott Tomlinson on behalf of my colleagues, Paul and Diane. We want to wish you a great rest of November and look forward to seeing you all, or hearing you all, or you hearing us in December. Take care.